Hey everyone, welcome back to Corporate Decoder. Today we are diving into Zillow Group's latest filing, and let me tell you, it's a pretty interesting one. Think about it. What happens when a company suddenly decides to go debt-free? It's either a genius move or a sign of something else. Let's find out. That before we get started. If you appreciate getting straight insights from corporate filings, make sure you're subscribed. We also have a Discord community linked in the description below where you can chat about this and other companies we cover. Alright, so Zillow Group just released a report about something big they did, paying off their debt. The headline, they settled their convertible senior notes, which is a fancy way of saying they paid off a type of loan, and now they're practically debt-free. What does this mean for you and for the company? Let's dig in. The main thing here is that Zillow settled its approximately $419 million debt. They had these things called 2.75% convertible senior notes. Think of these notes like a promise to pay back money with a little bit of interest, and the convertible part means that under certain conditions, the people who own the notes could turn them into company stock. To make this debt go away, Zillow paid about $425 million in cash. That includes about $419 million to cover the original loan amount, about $6 million for the interest that had built up over time, and a small amount of cash to avoid dealing with fractions of shares. On top of that, they also handed over a little over 1,300 shares of their Class C capital stock. Now, Class C stock is a type of stock that the company offers, so it's not necessarily a one-to-one, but it's still something of value. So what does all this mean? Well, Zillow is essentially clearing its financial slate. Being debt-free can make a company look more attractive to investors because it suggests they are financially stable and don't have a big burden of debt payments hanging over their heads. They mention a credit facility for Zillow Home Loans, but the core business is now clear of debt. Now, for my take Q on the surface, paying off debt seems like a smart move for Zillow. It reduces risk and can free up cash for other things like investing in new technologies or expanding their business. However, it's always good to ask why now. Interest rates have been relatively high, so paying off now means they've accepted the cost to essentially clean up shop. What's next for them? Are they looking to make themselves attractive for another business transaction? It's also possible they anticipate difficult times ahead and want to reduce their obligations. It is worth remembering that Zillow is in a tough market. The real estate industry is always changing, and they face competition from other online platforms and traditional real estate agents. Changes in interest rates, housing prices, and consumer preferences can all impact their business. We can only hope that this debt repayment will open up to other positive outcomes. Alright, that's our breakdown of Zillow's latest filing. What's your take on these moves and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.